Hey everyone, welcome back. We always talk about those big splashy headlines about company profits, right?
Right.
But today, we're going deeper, looking behind the curtain at EBITDA and free cash flow. These are the metrics that tell us what's really going on.
I'm excited to dig in.
Me too, and thankfully we've got some great YouTube videos to guide our deep dive today.
They really break these concepts down in a way that anyone can understand.
Totally. Okay, so we've all seen it. A company announces huge EE profits, but then later, you hear they're struggling.
Oh, yeah.
EBITDA and free cash flow help us understand that disconnect.
Yeah, it's like getting a peek behind the scenes, seeing how much cash is actually being generated.
Exactly. And what better example to use than Google, right?
Perfect example. Everyone knows Google.
Plus, they're pretty transparent with their financials, which is awesome for us.
Right. So, the EBITDA versus net income vs free cash flow explained simply video, they start with Google's net income for 2023, a cool $73.7 billion.
Wow. Just casually dropping billions there.
Right.
But that's net income, and that's calculated using accrual accounting.
Yeah, accrual accounting. This is where it gets interesting because accrual accounting, it records revenue when it's earned, not necessarily when the cash is actually in hand.
Right. Like, imagine a business buys a big piece of
Right.
equipment, right? They don't record the entire cost on the income statement right away.
Exactly. That's where depreciation comes in. Like the EBITDA versus net income vs free cash flow explained simply video, they use the example of a car, right?
Oh, yeah, yeah.
You record the depreciation of that car every year, but you paid for it all at once, probably.
Makes sense. So while net income is important, we need to dig deeper for the real cash picture.
Exactly. And that's where free cash flow comes in, which the EBITDA versus free cash flow investment banking interview cues video, they love free cash flow.
They call it the cash generation of the business.
Because it is. It's what's left over after a company reinvests in itself, like new equipment, property, all those Google data centers.
And that EBITDA versus net income vs free cash flow explained simply video, they actually break down the calculation using Google's cash flow statement.
Oh, cool.
They start with cash flow from operations, subtract capital expenditures, bam.
Uh-huh.
$69.5 billion in free cash flow for 2023.
Still a lot of money.
Oh, for sure.
Yeah.
But so much lower than their net income. It shows how much they're reinvesting.
Huge difference. And that's the whole accrual versus cash accounting thing again.
Exactly. Accrual accounting can kind of mask those big one-time expenses.
For sure.
Okay, but we can't forget about our other VIP metric, EBITDA.
Oh, yes. EBITDA.
Earnings before interest, taxes, depreciation, and amortization. It's a mouthful.
It is.
But the EBITDA versus net income vs free cash flow explained simply video, they describe it as a way to see a company's operating profit more clearly.
Yeah, you're stripping away stuff like debt and those non-cash charges.
So we're kind of isolating the core business performance.
Yeah, there's actually, you got it. It's really useful for comparing companies with different structures, too.
Like one company might have tons of debt, another might have very little. EBITDA helps us compare apples to apples.
Exactly. You said it. But, and this is a big but,
There's always a but.
the EBITDA versus net income vs free cash flow explained simply video, they mentioned it can be, well, distorted by management.
Oh, interesting. So it's not a perfect metric.
No metric is perfect.
Right.
And remember, it's still based on that accrual accounting.
So we're not seeing the actual cash impact. We got to keep divvying.
Always got to dig deeper.
It's all about context, right?
Yeah.
And that leads us to, well, the EBITDA versus free cash flow investment banking interview cues video. They talk about capital intensity. What exactly does that mean?
So capital intensity is basically how much money a company has to pump back in just to keep things running, to keep growing.
So a software company, they don't need to invest as much in physical stuff compared to like a company that makes cars.
Exactly. That's it. Think of a huge factory, all that equipment, high capital intensity, software, way lower. And that difference, it really changes how we see EBITDA versus free cash flow.
Because those heavy industries, they're pouring money back into machinery infrastructure.
Yep. So you look at EBITDA, but then you got to factor in those capital expenditures. It gives you a truer sense of their cash flow after all those big expenses.
It's not just about making the product, it's about like the whole system to support it.
Right. And, the EBITDA versus free cash flow investment banking interview cues video, they brought up something that's often forgotten: working capital.
Oh, right. Working capital, that's the short-term cash that companies need, right? Like to make payroll, pay their suppliers, keep everything running smoothly.
Exactly. And changes in working capital, that can really mess with free cash flow.
Mm.
Imagine if a company's customers are slow to pay their bills. but that company still has its own bills to pay.
Ouch. Yeah, that'd be stressful.
Big time. Even if their income statement looks good, their cash flow could be hurting.
So managing those accounts receivable and payable, that's key.
Absolutely. And the EBITDA versus free cash flow investment banking interview Q's video, they talk about that balance, right?
Yeah, like delaying payments to suppliers might help your cash flow in the short term, but then you risk your relationships with those suppliers.
Exactly. And on the flip side, you got to be on top of collecting those payments from customers. High sales are great, but if you can't turn those sales into cash quickly, well, that's a warning sign.
It's like a juggling act, keeping all those cash flows in check.
It really is. Free cash flow, it's not just about those massive expenses, it's about all those daily ins and outs of cash.
So we're seeing the whole picture, not just snippets.
Exactly, the big picture.
Okay, so we've talked about free cash flow, but let's loop back to EBITDA for a sec.
Yeah.
We said it can be, well, manipulated, right? Especially when it comes to those non-cash charges like depreciation and amortization.
Yeah, I can get a little,
Fuzzy.
fuzzy's a good word.
So how do we get a clearer picture when we're looking at EBITDA? What should we watch out for?
So one thing that can help is looking at EBITDA margins. It's basically expressing EBITDA as a percentage of revenue.
Okay, so it's like standardizing it so we can compare different companies.
Exactly. Like comparing a small bakery to a giant coffee chain, their numbers are going to be totally different, but EBITDA margins give us a way to compare them fairly.
Makes sense. But what about those non-cash charges themselves? The depreciation and amortization. Are those always straightforward?
Ah, now that's where it gets interesting. Remember we talked about that software example earlier?
Yeah, the lifespan of the software, right?
Right. So how long they expect that software to be useful, that really affects the depreciation expense. And those estimates, they can change.
So even if it's not intentional, a company could adjust its depreciation assumptions and boom, their EBITDA looks different.
Exactly. That's why you got to dig deeper. Look for consistency. If a company's depreciation is always way higher than everyone else's in the same industry, red flag. Time to investigate.
And amortization, that's for those intangible assets, right?
Yep, things like patents, trademarks, stuff that's hard to put an exact value on.
So it's even more open to interpretation.
Kind of, yeah. It's about judging how transparent the company is being with their accounting. Consistency is key, again.
It sounds like healthy skepticism is never a bad thing when you're looking at these numbers.
Definitely not. You gotta understand the nuances, the potential problems.
Don't just take the numbers at face value.
Exactly. It's all about the story behind the numbers. You gotta figure out what they're really telling you.
Now, we've been talking about Google, which is, a huge public company. But what about smaller businesses or startups? Do these same ideas apply?
That's a really good question. The basic principles, yeah, they still apply. EBITDA, free cash flow, those are important for everyone. But there are some things to keep in mind for those smaller guys.
So, what should we be looking out for with startups? What makes them different?
Well, for startups, especially the ones that are really trying to grow fast, profit isn't always the main thing?
It's more about getting big quickly, capturing that market share.
Right. They might be pouring every dollar they make back into the business.
Like research and development, marketing, all that stuff to scale up.
Exactly. So you might actually see negative free cash flow, which normally that's a red flag.
Yeah, you'd think so.
But for a startup, it might just mean they're investing heavily in their future.
And those investments, they don't always show up in the traditional accounting numbers, right? At least not right away.
Exactly. Like building a brand, developing new tech, that has value, even if it doesn't mean big profits immediately.
So investors are looking at different things with startups then.
Kind of, yeah. Things like, how big could this company get? How good is the leadership team? Can their business model actually scale?
So it's not just about comparing